Hey everyone, welcome back to Corporate Decoder, the place where we pull back yesterday's news for today's truth. Today we are diving deep into American healthcare. REIT is latest financial report where some big numbers paint a fascinating picture of their business. Think of it as a financial treasure hunt. Before we start, if you love getting these straight up financial insights, make sure you are subscribed. And if you want to chat about this stuff and join a community of fellow corporate explorers, check out the Discord link in the description below. Alright, let's get into it. We're looking at American Healthcare REIT, or AHR Incorporated, and their latest quarterly filing. They are a major player in healthcare real estate, owning and operating facilities like senior housing and outpatient medical buildings across the US, and even in the United Kingdom, they've been busy too, with a lot of acquisitions and new developments. First up, let's peek at their balance sheet as of the 30th of September 2025. This is like a snapshot of their financial health. Their real estate investments alone are valued at nearly $3.6 billion. That is a massive portfolio. Their cash on hand also jumped significantly, from about $76 million at the end of 2024 to over $147 million by September of 2025. That suggests they have a good amount of ready cash, which is always a positive sign. Now, let's talk about how they actually made money. Their revenues are broken down into resident fees and services and real estate revenue. For the third quarter of 2025, their total revenues were over $572 million, a nice bump from the same period in 2024 when it was around $523 million. The 9-month figures show a similar trend, a solid increase. What is really interesting is that their resident fees and services revenue, which comes from places like their senior health campuses, grew significantly. Specifically, for the 9 months ended in September 2025, this revenue stream reached over $1.65 billion compared to about $1.52 billion in the prior year. This growth in their core services is a strong signal of business expansion. Let's break that down further. Their integrated senior health campuses, or ISHAs, saw their resident fees and services revenue go up by over $40 million for the third quarter alone. This is thanks to more residents and higher service fees. Their senior housing operating properties, or SHOP, also posted solid gains. On the real estate revenue side, which comes from things like outpatient medical buildings, there was a bit of a dip. Real estate revenue for the third quarter decreased by over $3.5 million, mainly due to selling off some properties. The triple net leased property segment, which are properties leased to a single tenant under long-term contracts, also saw a decrease in revenue due to property sales. This shows a strategic shift, perhaps moving away from some of their leased properties to focus on their operating facilities. Looking at their equity statement, we can see how their ownership structure has changed. They've had some significant stock issuances, especially in the public offerings in February and September of 2024. This means they've raised a lot of capital by selling more shares. Their additional paid-in capital has ballooned, which is a direct result of these stock sales. This jumped from about $3.7 billion at the end of 2024 to over $4.2 billion by the end of September 2025. That is a $500 million increase in just 9 months from stock sales. This is how they fund their growth and acquisitions. Now for the cash flows for the first 9 months of 2025, their cash from operating activities was over $239 million. That is a huge jump from the same period in 2024, which was around $116 million. This is excellent news, showing their core business is generating much more cash. They used nearly $373 million in investing activities, mostly on acquiring new real estate. This increase in operating cash is a really strong indicator of health. It means their day-to-day business is becoming much more profitable. On the flip side, they are spending a lot of money on investments, about $373 million for the 9 months ended in September 2025. This is a big increase from the prior year, showing they are actively acquiring new properties, fueling their expansion strategy. Financing activities provided over $195 million in cash for the 9 months of 2025. This is largely due to the large equity offerings we saw mentioned earlier, where they sold a lot of stock. Let's dig into those acquisitions for the 9 months ended the 30th of September 2025. They bought a lot of new buildings. This included 11-ish properties and 4 SHOP properties. They paid a total of over $337 million just for these acquisitions. This aggressive acquisition strategy is clearly their main growth engine. However, not all investments are winners. They took an impairment charge of over $3.7 million in the third quarter and a much larger $38 million for the 9 months ending in September 2025. This happened with some of their outpatient medical buildings. It means these properties are worth less than what they were on the books. This is a reminder that investing in real estate, even healthcare real estate, comes with its risks. Looking at their debt, they have a major credit facility, the 2024 credit facility, worth up to $1.15 billion. As of September 2025, they had borrowed over $550 million on this. This facility is crucial for their ongoing operations and acquisitions. They meticulously track the fair value of their assets and liabilities. Their derivative financial instruments, which are used to manage interest rate risk, are valued in the millions. For instance, as of September 2025, they had derivative financial instruments with a fair value of $173,000 on the asset side and negative $1.28 million on the liability side. This shows they are actively managing financial risks. Now, let's look at how each segment is performing. Their ISHC segment is the powerhouse, bringing in over $61 million in net operating income for the third quarter of 2025. The shop segment also contributed positively, adding over $16 million. The outpatient medical segment, or ON, and the triple net lease properties also generated income, though the OM segment's income took a hit due to property sales. This segment information is key. It shows where the real money is being made. ISHI and SHOP, where they directly operate the facilities and provide services, are driving their core revenue growth. When we look at funds from operations, or FFO, a key metric for REITs, AHR shows impressive growth. For the third quarter of 2025, their FFO attributable to controlling interest was over $93 million, a huge jump from about $35 million in the same period of 2024. This metric helps to strip out some of the non-cash items and focuses on the cash generated by their real estate operations. Their normalized FFO, which adjusts for certain one-time or non-cash items, also shows strong growth, hitting over $75 million in the third quarter of 2025. This indicates that beyond the basic FFO, their core operations are very healthy. Now, no company is without risks. One of the most interesting new risks mentioned is the impact of artificial intelligence. They're exploring using AI, but they're also aware of its potential downsides like bias, errors, and cybersecurity threats amplified by AI. Also, they're keeping an eye on changes in laws, like healthcare reforms and tax laws, which could significantly affect their business. The report mentions new legislation, the One Big Beautiful Bill Act, or OBBA, which includes some tax code changes and Medicaid spending cuts. These could certainly impact the healthcare industry they operate in. Overall, American Healthcare REIT Incorporated is showing strong growth, especially in its operating segments like ISHI and SHOP. The company is aggressively acquiring properties to expand its portfolio. Their financial health looks solid, with increasing revenues and cash from operations. The increase in stock issuances shows they are actively raising capital to fund this expansion. However, there are clear risks. The impairment charges on some of their outpatient medical buildings highlight that not all acquisitions pan out as expected. The potential impact of AI and ongoing legislative changes in healthcare also present uncertainties. Despite these challenges, their core business of providing healthcare and senior living services appears to be thriving, driving their impressive revenue and FFO growth. They are clearly betting on the continued demand for senior housing and healthcare services. So, what is my take? American Healthcare REIT is in expansion mode. They're making smart moves to grow their operating segments, which are the true revenue drivers. The financial tables show a company that has successfully tapped into capital markets to fund this growth. However, they need to keep a close eye on managing those acquisition risks and navigating the evolving regulatory landscape. Their strong FFO growth is a very positive sign, suggesting the core operations are sound. It will be important to watch how they manage their debt and the success of their new acquisitions in the coming quarters. Alright, that is our breakdown of American Healthcare REIT's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into how the corporate world really works. And don't forget to join our Discord community for even more insights and discussions. The link is in the description below. Thanks for watching, see you next time.